Good afternoon. Welcome to Chicago. Future of Finance here in the corner of Jackson and LaSalle at the Cboe trading floor. I'm Oliver Renick. Stocks simmering after just trying to break out to all-time highs. Technically, we did get them by an inch on the closing basis last week. But as I pointed out, I am a candle chart type of guy. If you can trade it, it should count for your technical analysis. And we didn't get the intraday all-time high last week, which is one of the reasons why I was a little bit hesitant to turn the light green on my risk radar. It is still yellow for stocks and red for BTC, as coins were quite weak over the past couple sessions. They are firming
Brent,
up
just wanted to
today,
confirm you can hear me,
which is nice. But we also don't have a real breakout in coins either. So overall, the market is, I think, firming up a little bit today. Bitcoin up a tad. You've got Tesla making a move. Hard to be bearish on the market when Tesla's breaking out. Look at the chart for Tesla as a really important company still. I mean, you just can't ignore the stock by any means. We had the range trade below 470 bucks for the last 3 months. Tesla now trying to make a move for a breakout to 52-week highs. You can see that over here at 490, just so close to really getting a real ripper for Tesla. It's a good-looking chart, and it's hard for me to get negative when you have Tesla looking as firm as it does right now, and Elon crossing 600 billion. We'll talk about that with Pete Najarian joining me from Market Rebellion. We've got a great show coming up. Brent Kochuba, SpotGamma as well to analyze the flows. We've also got a fantastic ATP profile exchange traded guest in Matt Sigel from VanEck, the head of digital asset research, to talk about their Node ETF, NODE, which is a really fun one. It's got some Bitcoin, but it's got a lot of other stuff in there as well for the on-chain economy. And since its launch, even though it's pulled back substantially, it's already still on a bit of a ripper for the year. There's NODE. We'll talk about up 31%. That's since May, so not too shabby of a performance there by any means. Scott Bauer joins me from Prosper Trading Academy after we came back from Vegas last week, which was a lot of fun and a really great conference where we did talk about the technicals in the market that have been demanding a little bit more momentum than I think bulls would want to see. But obviously bears just also unable to really keep this market down for longer than a few hours or so. That's kind of been the conversation we've had with Brent quite a bit here. Mr. Kochuba, founder of SpotGamma, joins me. Brent, good afternoon. This is a market that seems largely calm. I described it as simmering under recent highs. VIX 16.5 still says like maybe this is more of a chop than any real downside developing. What do you see?
Yeah, hey Oliver, thanks for having me on again. We've been whipsawed here. Last week we were talking about the cheap calls up in the 7,000 area, and it seemed like we're poised for a breakout. We pulled back to 6,800. 6,800 came under fire again today, but we've had so many rallies, 1% rallies up and down last week. And just on Friday, we're talking about those cheap upside calls again. And staring at those things. Noel came on after me and thankfully kind of echoed some of the sentiment I had, at least in terms of those options being fairly cheap. And you stare at those things and they're still sitting there, those cheap calls sitting up in that area. And I got a little beef today with some people about this idea of seasonality. And the point of the seasonality is I don't believe in Santa Claus and the Santa Claus rally necessarily, but what I do believe is that you have events that have come and passed, like NFP today. We have CPI on Thursday. CPI has about 3 vol points of event vol associated with it. And if that passes without issue, that vol contracts. And if that vol contracts, it helps lift the market up. We also have VIX expiration tomorrow morning. So you're talking about VIX being somewhat elevated, and VIX 16.5 is not terribly elevated, but 1 month realized vol is a 12. So what that tells me is that there's a fair amount of volatility premium in this market at the moment. And then the second thing to note here is that we give way to next week, Christmas and Christmas Eve. So Wednesday is a half day, Thursday of next week is a day off. Oliver, I don't know about you. I mean, I got to work every day, unfortunately, but I'm guessing you're taking the day off, traveling to Vegas, wherever else you're going to be.
the
point
more
is the holidays
independent
are
you
here,
are,
right?
the less clear it is whether or not you're working. That's what I found out. That's the irony, is when you're an entrepreneur, you're not actually on the clock, but you're always on the clock.
Welcome to the dark side, Oliver.
Yeah, but of course, it's also very rewarding. So with that said, what does that do, Brent, for the, again, to kind of think about it in terms of vol, because the main thing, as you mentioned earlier, the baseline has been cheap upside calls have been, kind of an appealing, I found that to be an appealing way to play this. Low vol, market simmering, why not take a shot above 7,000 for an out-of-the-money call if you're overall hopeful, the potential for that gamma wall to break and cause that kind of flood of buying. Obviously that has not happened, but is that still an appealing play to make? Because I'm looking at Tesla breaking out and I'm like, why wouldn't I bet on the overall market doing the same still?
We were watching this level 6,800 and it broke today and we slid just a bit down, right? The reason I bring that up is because the opportunity for the bears just to slam this thing has been there and it just can't seem to come to fruition. Now, on the other side of the equation, I'm not bullish on any macro thing or any other reason except for the fact that these holidays make it hard to own vol, right? You have the events come, they roll off, you have the holiday period. That makes owning puts expensive. You're just going to carry these options over this holiday period where a lot of people aren't even paying attention to the market. And so the vol has a drag. The second one is you lose momentum. If you start to sell off, let's say hard into Christmas Eve, that's a half day, and then you have another day off. It's like, why are there circuit breakers in the market when it starts to crash so much, right? You want to break that momentum. So that makes it hard for a sustained sort of sell-off at this point. So that is just a headwind for bears. The second one is, why is that vol cheap into now? It's particularly in December 31st, because the JP Morgan collar trade that everyone talks about sitting up at 7,000, and it's suppressing volatility in that area, and it is making those cheap calls. And so there's this weird window right here where at a baseline it's hard to be a bear because the market, I think, is being supported by these flows. I still think we could have this cheap shot up into the 7,000 area, but the beauty of it is, maybe I'm wrong on that, it's cheap to bet on that, and that's something that Noel and I were both sort of mentioning. The bet is cheap, so if you believe in the Kelly betting system or risk reward, whatever it is, that is a cheap upside bet. Yeah. And so, Oliver, I don't know if you have the founders out there, but we were talking about two charts that were interesting on this point, and I just wanted to bring this up.
Yeah. Pulling it up right now, founders note on SpotGamma, which is a really great daily addendum that you have on your overall, for your newsletter. And then on the side as well. I'm actually on the trace right now looking at today's market, which was pretty much stuck here. Can you hit that for me real quick, and then I'll click over to the founder's note. But just since I'm here, Brent, are we pinned here? Is this a good type of pinning that prevents us from going lower?
We're not pinned at all. If you look at the straddle today, the straddle is pricing in about 40 points of movement, which felt pretty light. That was kind of a core point in our founders note this morning, is that vol estimate seemed kind of light. As you can see on the range there, we got a little bit more than that. We got about 60 handles of movement on the day. And so, the vol is underpriced. The fact that that map is so red is telling us that there's just a lot of negative gamma above and below. And what does that tell us? Vol should remain. We should still realize a lot of movement in this market. It's as easy to go up to 6,900 right now in very short order as it is to go down to 6,700. Now today, at this moment, the purple line going lower, you don't have that on there, but we have this hero indicator, and it was dropping and dropping and dropping. And then when we made the lows around 67.60, that order flow seemed to fade. The bears sort of backed off on the day, right? So, to this point, it's like you got them on the ropes, bears, and you can knock them out, and they just don't. Right? They just sort of back off.
They couldn't.
And so, that's a tough way to own puts. And the scary thing to me is this awkward right tail, which could push us into the end of the year, and then in January we could sell back off, right? So I'm not sitting here saying because of Santa Claus, I'm saying because we have the event vol contraction with NFP today. VIX expiration tomorrow is going to wipe out VIX calls that have some value. Vol risk premium is still elevated. Thursday CPI is probably a non-event. Most of these macro events don't cause any short-term headaches, especially the one before Christmas. And then immediately everyone's going to be thinking about, the Christmas holiday and not wanting to own puts through that period. So if you hit founders note there and just bring up today's founders note, I want to show these two charts. Yeah.
Yep.
So
I'm scrolling down.
Yeah, keep going. There's two charts. There's one. So that's the realized vol. Today's implied move, the straddle was 40 handles, right? 40 points. As you can see on the founders note there, that's the equity hub, those are ES futures moves over the last week. Every day since FOMC, we've moved at least 58 handles or more, as much as 100. So the market is sort of serially underpricing the 0 DTE options right now, which I think is going to keep the volatility elevated, and I think that's probably going to be true in through Friday. So that's the first dynamic. The vol still seems to be underpriced. If this was a risky market and people were scared, you would think there would be more volatility premium in options prices. We're not seeing it.
Right.
The second chart, if you scroll down there, Oliver, and this is where we get to the more prescient thing here. What are you seeing here, Oliver, is remember in November, we were talking about the VIX was at 2025, and we were kind of crashing into November options expiration. The problem with owning puts at that point was the week after options expiration in that period was Thanksgiving holiday and Black Friday. Well, what did the market do? On the day of November options expiration, which is lined on that chart, we rallied, right, because we cleared out all these put options, and then we just ripped right to Black Friday, right, which is on your chart there, and that was the high. So we just made this huge move, this short cover, vol crush, I call this Vanna, the chase, whatever the flows are that are backing that thing, right, the chase in price and the squash of vol pushes the market back up, right? That is this period right now. Yes, the VIX isn't at 20, but the VIX is still elevated relative to how much volatility we're getting. So that is the dynamic that we're looking at right now. Again, options expiration, VIX expiration tomorrow, OPEX Friday. Probably the biggest options expiration in history is going to be on Friday because it's the December end of year. The second chart I wanted to show everybody is if you go down, look at December 2024. One more chart below that, please, Oliver.
Yep.
This is December of last year. FOMC last year, if you remember, Oliver, the Fed came out and they said a bunch of stuff that the market didn't like, and we dropped 3.5% over the 1 to 2 days after FOMC, right? That's that first black line 3.5% drawdown. What happened? 2 days before options expiration, sound familiar? We ripped 3.5% to 60.50. Why did 60.50 matter, Oliver? Because 60.50 was the JP Morgan collar strike for 12/31. So it's the exact same setup that we see right now where the market has pulled down, not 2.5% or 3.5%, but the market has pulled down. Do you know how far away we are from the JP Morgan collar strike right now, Oliver? How far away is the 7,000 strike at the moment?
Well, we're at right now. Yeah,
we're about
right
2.5%.
Yeah, okay, we're at 68.50 something right now, 6,800.
6,800.
Yeah.
So 6,800
and the
up to
last time around, the
7,000.
strike was at 60.50. So we've climbed almost 1,000 points since the last collar strike, right?
Yeah, and if you look at the relative low of the market right before December options expiration on that chart there, it rallied 3.5% over the week to get to the JP Morgan collar trade. So in the same example, right now we're at 6,800. If we rally 2.5%, we're at 7,000, which is the JP Morgan collar position, which expires on 12/31.
Okay.
So the point here is this idea of seasonality is the expression of positions rolling off and volatility getting crushed over our holiday period. We just saw it in Thanksgiving, happened last year. Look what happened after we touched that area, right, into the last week in 2024. The market fell right back apart, right, to start, last week of the year and then kind of like January. So there is this window here where I think it's just very hard to be short, and that is what I think makes it a challenge. Once we get through Christmas and the last week of the year, then the dynamics change where I think that underbelly of the market, is soft. The downside price could be a little stickier, and I think the directional action could be a little bit different. But right now, I feel like, fighting, trying to short this market is trying to swim upstream. It's challenging.
Yeah, no, totally. Obviously, the call buyers haven't been rewarded, but neither have the put buyers, really. And unless, signaled otherwise, we generally assume the market will drift higher because that's what it does. So the pressure generally always on the bears to get their puts to pay more than the bulls necessarily. Hopefully, obviously people train 0 DTE, so if you missed your expiry, then that sucks, but that's kind of the name of the game. I think that's also why you've stressed to keep expiry kind of in your model and realize these dates that are important so that you're not trying to you might also be swimming against the current a bit, even if you ultimately get paid out on the long side if you're doing it too early or too short. Whereas I've kind of had the mindset that with vol this cheap, you might as well own a little bit of time. You might as well own a little bit of premium on the hope that it bounces back. My conclusion from these two charts, by the way, is that we kind of do this drift down and then bounce back around some of these important expiries. That one from the JPM caller back in December, but it was the same situation here as well with the November OPEX right there in the middle at 21st, that same V-shape situation. So if we're in the first half of the V, obviously this next half of the V should hopefully be to the upside.
Yeah, and I think that, you can anchor to that 7,000 because there's that huge position there. And again, this is a sort of 1 week view of, after this, I'm going to stop talking about the upside really in these cheap calls, right? Because that dynamic is gone. And so, that is the clear situation. And again, under 6,800, there was this ability for the market to start sliding lower. That was our risk pivot. And we saw about 0.5% to 1% of downside under that level. And bears are getting rolled over again right now. So, I'm really worried about that sneaky right tail, but I fully admit that was something we were talking about over the last week as well. So at the risk of sounding like a broken record, we'll move off that topic.
Yeah, no, I love it. I think it makes sense. I think that simmering is one way to think about it, pausing, and maybe just resetting ahead of some of these important dates on the calendar, which is one of the big reasons why we watch options flows, to understand what those important dates are. Great stuff. Thank you, Brent. Appreciate your time. As always, you're the man, Mr. Brent Kochuba, joining us from SpotGamma. Scan that QR code to get the free daily flow report. And then when you're in there, look for that founder's note too. The founder's note is really good. Nice mix of macro into the flows stuff as well. That's obviously really important. Market right now, as we talked about, sitting fairly unchanged at 6,800 for the S&P 500, down about 1/3% right now, as we do see the Bitcoin still holding on. Here's the chart for the S&P. Obviously, pulling back the last few sessions, but a pretty good situation overall for a market as we are just kind of hovering, and VIX looks pretty calm. Let's keep it going here. Got a great lineup today before we get into crypto with the team at VanEck. Let's talk some volatility. Let's talk some economics. Got Mr. Pete Najarian joining me from Market Rebellion. Pete, how are you, sir?
I'm doing great, Oliver. You're looking sharp today, as always, I see.
Thank you, sir. I got some decent sleep, working on that routine, Takes practice.
Yeah.
I know it's part of your guys, you're in particular, your walks through the woods are very inspiring. You're right? You got to have something to keep you regimented.
I got some black bears out there too, so I got to outrun them, man.
Seriously, yeah, I bet. So wild down there. Pete, the market is distinctly, I think, kind of tamed right now. We're talking about vol 16.5. I know the last couple days there were a few doozy moves that folks got caught, by surprise by. Bitcoin got hit. A few of the key tech companies got hit, obviously, after Oracle, but overall, none of that seems to have been able to facilitate any real downside, and we do see crypto firming back up today alongside Tesla.
Yeah, and I think part of that is the fact that, this earnings season has saved us time and time again, right? And it never really feels like it ends because there's always the next set of earnings that are coming out there. But, the big boys really helped things out, I think, when we started off with the financials. We've moved through that. And, yes, there were a couple where we took a hit, right? You look at the AI trade, and certainly you get a little bit nervous about what happened with Oracle. Now, Oracle had an unbelievable run, however, before that. So that's one thing. And then you look at something like a Broadcom. So were they disappointing? I'd say they were absolutely disappointing. But there are a lot of concerns out there about what's going on with AI. Is it a bubble? Is it ready to pop? All these different questions. And I think that we are still scratching on the beginning parts of what we're seeing, I think, when it comes to AI and data centers and all the energy factors that go along with that. So I think there are some opportunities that literally are made in front of us when we've got some of these pullbacks.
To your point, a lot of winners that, pulled back. So the idea that we could have, those pullbacks, we could have downside, we could have reset, I do think needs to be part of our understanding for markets. Anytime you have a big run thematically in any of these groups, whether it's the semiconductors, which still put in a higher high, whether it's quantum stuff, which put in a higher high. A lot of these charts still look pretty darn good. And one that I've been watching very keenly, of course, is NVIDIA still. We're still above 175 there, which was my line in the sand for that stock.
Mm-hmm. No, it makes a lot of sense. And I think that's what you've got to do. You've got to approach the markets with, all right, where have we been? Where have we gotten to? And where are we right now? And what does it look like for the future? And I think when you look at that I don't think that there's nearly the pressure that everybody else seems to feel that's out there. I think that, to your point, unless we really crack down and take a pretty big slap to the downside, I feel like there's a lot more green to be had into the future here. So are we going to have this rally and Santa Claus rally and all the things? I pay attention to that, but I really don't really watch that closely. I'm always looking at the options. I'm looking for unusual options that are going to give me what I think is going to be a leg up on everybody else. And it's been incredible of late. Volumes exploded over the last day or so. It's been pretty incredible once again. So I'm pretty excited about where we are right now going into the end of the year, and obviously as we kick it off into January.
By the way, within all of this, a stock that is generally one that signals, I think, risk appetite still pretty well is Tesla, partly because of the love-hate relationship many have with the Elon, which kind of adds some beta, some velocity to it. And of course, the fact that it's ingrained into some of the biggest, if not the biggest, tech themes. There was also for a while a little policy premium in there too. So it's like you name it, Tesla's got it as an input. And now SpaceX going public puts Elon above the 600 billion mark, according to Forbes. I feel like this is a conversation that we got to have. There's the Forbes article right there, $600 billion. So that's probably not negative for Tesla, thanks to SpaceX.
I think it's pretty impressive, and especially the fact that it wasn't too long ago, 4 months ago, they said, well, SpaceX, we're going to say this is probably a market cap of somewhere close to 400 billion. Well, that number now has moved to 800 billion. And you know what? By the time it actually happens, I wouldn't be surprised to see it even a little bit higher than that. And what will that do for, our good friend Elon? I think he's going to be pretty daggone impressive, quite frankly, because he's already at 600 billion. He's got a pretty good step on everybody else. And I think his valuation is going to be even higher in a big way when it comes that time. Now, he doesn't own the entire thing. He's got, I think, 42%, something close to that. But I'll tell you what, if these numbers that we're seeing are anything close, I think it says a lot about what Elon has been doing. And quite frankly, I think that he's bounced back a lot when we talk about Tesla. People were kind of bashing and they're bashing him and all that type of thing. Well, I would say that he's come back pretty nicely. I mean, just take a look at that thing since the times of the Trump.
Yep.
And all
I just pulled up the 3-year chart. I mean, this looks like up and away to me. It looks like if it gets through 500, you could get another vertical move in this thing.
And a lot of people are out there betting on that in the options world. As a matter of fact, we had 2 major hits today in the option side of things. Stock was trading right around probably about where it is right now, call it 480 at the time, but they bought 11,000 of these February 600 calls, the 600 calls I said. And then they actually bought 29,000 of the December 510 calls. That was part of a roll-up. So there is still an appetite out there thinking that, you know what, Tesla's made a heck of a move, but Tesla's going to make an even bigger move over the next couple of weeks, maybe a couple months.
The expiry, you said December, Pete, was that the 26th?
Yes. Yeah.
Okay. Not this Friday.
No.
Okay. IV rank right now, I mean, it doesn't look particularly high implied vol for Tesla. It's not screaming for December. So, I don't know, these... do we describe them as affordable, or is that just kind of they went out so far to 600? I mean, I got to push my strikes way out if we're going to get to 600 because this is such a highly traded stock.
Right. And when I see these kind of trades, Oliver, I think for any of the folks out there that are not professional traders, they're not on the trading floor, they're not, somebody at, a monster fund of some sort. These are things that when you see them, they're fantastic. I think it gives you an idea of what the thought process is out there. But I think spreads make a lot of, sense under circumstances like this. Just because the call action that we're seeing doesn't mean that's the only thing you can do. You can always create something with spreads. And that's something, hopefully, you've got to have the knowledge to do that, of course. But you've got to understand exactly what that means, how that's going to, play out. And you're going to give some of it away, right? Potentially, if it does make some unbelievable move to the upside. On the other hand, you're putting up a little less risk when you're actually spreading it off.
No, I like that point, especially I think it makes total sense for a stock like Tesla because it's expensive nominally to trade those contracts, but also it's a mover. So, you can still get a big move and get a good payout, even if you spent some to hedge it, even if you sacrifice some. So I do think it makes sense for Tesla. When we think about the other major themes here, Pete, I feel like it's worth discussing numbers from employment today, as well as what that's going to mean for some of the macro stuff, which I always like to talk some macro with you. Thinking about the jobs report, I mean, it could have gone worse. right? I think that's the case. You know, it could have been a disaster, but instead we added 64,000 for non-farm payrolls when they were looking for less. And a bond market's pretty calm about it. What do you think?
Yeah, I think so. I think the biggest thing that people were focused on more than anything is that unemployment number, right? I mean, there were some concerns because of that. We've moved up just a little bit higher at 4.6. It's about a 4-year high. So it's something I think that we're all paying attention to it. But, you know, we've had the government shutdown. We've had all these different factors coming on. And it's interesting because even with all of that, well, the S&P, and I think your previous guest was talking about this, has been banging around at new record highs. So I think people are digesting this very, very easily, very rapidly, and deciding, you know what, things still look pretty bright out there. And yeah, the unemployment at 4.6 is not optimal, but at some point, maybe into the future, maybe we see that start to pull back again.
Okay. Pete, the bond markets, I'm watching it real closely for the 10-year. It kind of, you know, looks like it wants to break higher, actually, but it's obviously going to take some effort to sell bonds. We keep bouncing around this 4.2. This line, man, I love when lines on my charts work. I don't know if you're the same way I am, Pete, but I love a line hold, you know? And it just, that 4.2 is holding like, I don't know what, you know? Look at this thing.
Oh.
It just...
I think you're exactly right. I've been talking about this for a long time with John and a lot of the folks here at Market Rebellion. I've been just saying, you know, it's interesting because we keep bouncing up towards that 4.2 level, right? And then we seem to pull back. And then we get up there again. We seem to pull back. And I think your chart says exactly that. It's been interesting. Do we actually see it going back above that level and then starting to move more to the upside? I really don't feel like that's the case right now. It feels like that is the line in the sand, at least for now. And we'll see how long that can hold up. But I feel like that's something that can hold up into the early parts of 2026. And I would expect to see a whole lot of movement much higher than that. Yeah, you can pierce it, but I don't think you're going to close over 4.2, even though it's sitting right there right now. It's been moving around, and we've been talking about this for a while, somewhere between, call it 4.1 to 4.2. It's been a very, very tight range for the most part.
Yeah, it really has. I think it'll be newsworthy if it breaks above 4.2 to the upside. I think less newsworthy if it stays below 4.2, but at least we have a threshold to think about fairly clearly. I think on that, yeah. I think we see on the same eye on there. Hey, Pete, to close it out, always like to get your hot sports take. This one's a little bit out of my realm, but I am going to pull up some stats from my friends at Real Sports, Real App, as an alternative. I know we call this segment The Gamble, but this is kind of like the Gamble alternative. My friends actually built this company. It's a fantastic sports analysis and data-driven social app called Real, because they've got their top tweet today is something you texted me about, which is this kid, Cooper Flagg, who's playing for the Mavs. Is that right?
Yes, Mavericks. He's one of the top picks in the draft. He's a special kid, came out of Duke. I'll tell you what, he was making a lot of money while he was at Duke. Now he's making a lot more money now that he's in the NBA. But he did something that nobody has ever done before. He's an 18-year-old kid still. He's going to have a birthday fairly soon, but an 18-year-old that actually got out there and had a 42 points, set the new record, 42
Looking
points.
at it.
18-year-old player. How about that?
Wow.
And by the way, the kid was a 3.5 GPA, so he's got the academic side. He's got the sports side, obviously. He's one of the most special players to watch. I mean, last year during the tournament, he was unbelievable. I'll tell you what, he's a special guy, and Dallas is very lucky to have him.
Seems like Dallas has definitely got something going in terms of their ability to pick stars, right? I mean, no question about it. That's pretty impressive. Just it seems like there's always a breakout. Whether it's the kind of marketing side of it, the sports expertise, the combination of them both. Just it seems like anytime there's something hot on the court, it's Dallas connected. Also, he got 7 boards too, so he's no slouch by any means.
The guy does it all, man. I mean, honestly, he's like so many of the guys before him, where he's just a special player, and people are going to know more and more about him as he gets deeper into an NBA career, just because he can do it all. He's aggressive enough to go in there and get the rebounds. He's aggressive enough to be able to also be a great teammate and give people some assists along the way. But he's a special guy, and I'll tell you what, as a free throw shooter and as a field goal shooter, This guy is money, absolute money, and he's not so bad from three-point land either.
Yeah, 40 bomb. Here's some of the stats that they got for him as well. 48%, from the field, so pretty darn good.
Yeah.
And I like that they retweeted a hot take from someone saying that he was going to be a bust. Pete, always keeping me informed in many ways, from economics to sports. Appreciate it, Mr. Najarian. Thanks a lot.
You're the best, Oliver. Thanks a lot. Have a great day, man.
You got it. You too, Pete Najarian, co-founder at Market Rebellion. All right, we're going to take a 2-minute buffer break from Innovator. Then we come back and we're going to talk some coins. Head of digital research at VanEck, Matt Sigel, joins me to talk about the NODE Node on-chain economy ETF. That should be fun. Be right back. I'm muted, but I just always to be safe. Boy, are we cruising today.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovator's floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Welcome back to Chicago, Future of Finance. The future theme today includes crypto. I'm excited for today's exchange, traded product. We're going to get into the crypto world with the team at VanEck as we look at NODE Node. Matt Sigel joins us from VanEck, the head of digital research. NODE, which launched in May, is up 30% plus since the debut. Matt, thanks for being here on the show.
Hey, Oliver, good to see you.
Likewise. I like that you got HODL up on the hat because that's actually part of this fund. Start by telling me about the construction here as I pull up the chart, because you guys obviously have pulled back with some of the crypto stuff over the last month and a half or so, but it's still been a beast since the debut. Up, let me get sure I got the number right, 33%. Tell me about what you guys are doing with this.
Yeah, Oliver, we took a little pivot at the end of last year when we noticed the altcoins were overbought, and our hunch was that the deregulation from the Trump White House would send more value into the equity markets, and that's really what we've seen this year. You know, IPOs, SPACs, pipes, capital formation coming in the equity market. And so this strategy is trying to capture the winners from that trend, companies that are either making money or saving money from the adoption of Bitcoin and digital assets. And it's a more diversified approach than just sticking with pure plays. But when you look at the value chain for this industry, it actually shares so much in common with AI, you know, starting with the energy intensity and the upgrades to existing data centers, new construction, and that's been a big driver of returns on the upside. I think now what we're seeing is that Bitcoin correlation with the equity market is quite elevated, and from my perspective, it's inextricably linked with the AI trade, and that's what's driven part of this correction over the last couple months.
Okay, so tell me about that real quick, the way you see it, because the way I've seen it is that there's been some decoupling between crypto and the equity markets. In the spring, it was kind of a positive thing, the timing, whereas the market was getting hit for stocks due to tariffs. Crypto had kind of already gone through a little bit of gyration, and so it held up okay during that, even though its a total drawdown was still sizable. The timing was different. And then lately, obviously, with BTC down, what about from the high, about 30% or so. Obviously, stocks are pretty close. So, how have you viewed that relationship? Is that a better type of relationship with stocks? Is it improving, or what does it mean for you as a researcher on crypto?
Yeah, I mean, so if you just look at like the daily correlation of Bitcoin and the Nasdaq, rolling 30 days, we're at 0.5, call it. So we peaked in 2022 at the beginning of Fed tightening at close to 0.8, and that is a reason why some of these ETFs were delayed, frankly, is because people didn't want Bitcoin if it was 0.8 correlated with the Nasdaq.
Correct.
When the ETFs launched, that correlation was down at close to 0, and it made it a really attractive diversifier. So here, sitting at 0.5, it's definitely elevated versus the last couple of years' history. And I think that has to do partially with the Bitcoin miners being the tip of this AI trade. Many of them are spending significant capex to repurpose these data centers to serve the AI market. Their balance sheets are not strong, so they used Bitcoin as their cash cow to fund, along with debt, these significant capex. So when Bitcoin goes down and the AI kind of debt markets wobble a little bit, which is basically what's happened in the last couple months, those companies become even more levered. They have to sell even more Bitcoin to fund this pivot. And that's how the trade has got somewhat reflexive. Now, I'd argue that with Bitcoin down more than 30%, it's been a significant correction. If you volatility adjust that correction, it's almost as big as we had in the 2022 downturn. And we're starting to see some oversold levels, especially in some of these equities that are geared to this trade. But that's how I see, Bitcoin and AI is connected, and that's why these correlations, I think Bitcoin, Nasdaq, have risen over the last few months.
And I did this 30-day correlation to NDX to HODL to use the ETF, and to your point, it's up since the lows last month when it was actually negative. And then if you scroll back to late last year, much more positive, kind of the way that we think about the traditional risk asset overlap. So it's definitely gotten quite a bit choppier, which I actually, as a sort of a crypto cynic to some extent, my view has always been decoupling is good, regardless which direction, basically. Obviously, you probably, you hope that price decouples in a positive way for cryptos, but I think generally just decoupling is good, because then it makes it something more unique rather than just a higher beta or a different version of a risk asset. I wonder, Matt, how you feel about the quantum stuff and what role that has played. I have heard some, and I have no strong view on this, but I have heard some folks argue that this is a risk to the blockchain, to the security of the technology of cryptos. If you've got these extremely high-powered machines that can just break through the encryption, should we be worried about that at all?
I think it's been a little bit of an overhang on the price. I do. It's not an unsolvable problem for Bitcoin. It involves a community consensus, which is like herding cats in the Bitcoin community. So, one thing that we did in Node to try to mitigate this risk is we added a position in the VanEck Quantum ETF. Basically with the thesis that if Bitcoin was going to go to zero, maybe Quantum would 100x and save the fund.
I love that. Yeah,
I mean, it's
fun.
a kind of an alarmist way of thinking about it, but just to be protected, cryptography inherently is going to be interconnected with quantum. So
Sure.
something to keep an eye on. But I also want to remind folks the last time there was a big, community debate within Bitcoin, something called the block size wars 10 years ago, huge debate over whether to increase the throughput of the blockchain, extremely contentious debate, and that was a great wall of worry. Bitcoin had some of its best price action during that time. I think the market looks through it as long as the community's taking the threat seriously. There are a couple of Bitcoin improvement proposals that could be passed with consensus. So I look at it kind of, wall of worry, tail risk worth hedging.
I like that. It's almost analogous to another view that I have, that is the Bitcoin treasury trades, and those companies are presenting kind of a concentrated risk as well. So if you want to be long Bitcoin and short MicroStrategy, that's been my favorite trade all year, basically to give you a free night of sleep where you can have faith in the coins, but maybe less faith in the kind of compiling and levered version of them within a company. I pulled up your guys' holdings here, by the way, for NODE. Also, let me just say, for 69 bips, I was kind of impressed and surprised that the fee is that low for a fund that's fairly complex sort of in nature and structure, but I guess some of that comes from you guys using your own cooking in here, right? With the HODL ETF as a holding in there?
Yeah, and we're not going to double charge on fees, so there's a fee waiver if
Exactly.
we own, our own ETF. So don't worry about that. But yeah.
Mining, Cypher mining, IREN is up there, TeraWolf. Tell me about how you figure out how much Bitcoin to put in this fund, because you guys have another really interesting analysis, which is about the Bitcoin market cycles. I want to know more about how you guys move in and out of your own Bitcoin holding there to make sure that this is not just a Bitcoin beta play or a Bitcoin proxy. I think this is really interesting. Tell me more about how you guys are doing that.
Yeah, what you find from this equity universe is a lot of leverage and a lot of volatility. And you highlighted MicroStrategy there. Good trade on you for shorting that, against the coin. I would be cautious doing that from these levels. The valuations have really come down on these digital asset treasury companies, and there could be possibility of a value unlock through activism or M&A. There's actually some M&A that may close as early as first quarter next year between two DATs, which would unlock value. So, the way I think about those names is that there's enough leverage and volatility in this space that you don't need to take on more by buying a bunch of stuff with high financial leverage.
Exactly.
But at the right valuations, we're going to try to take some intelligent risk. So
Okay.
we're
Fair enough.
targeting a volatility level that's comparable to Bitcoin, whereas when you buy kind of a pure play crypto equity ETF, you're oftentimes getting twice that volatility because of all the financial leverage inside of those pure plays. So we're taking this very diversified approach with the entire value chain, including some of the lower vol, even utilities and midstream energy that are serving indirectly the Bitcoin miners. And then, per the chart that you have up there, when we notice, a lot of fear in the market, we're likely to turn up the dial on our volatility and pure play exposure, and vice versa. And that's how I think we've managed to, beat Bitcoin with essentially the same volatility since our launch.
Very cool. Okay, so tell me a little bit about your secret sauce for determining where you are in the Bitcoin cycle, Matt, as you want to turn up, obviously, your exposure when you think that fear is high and that, you want to obviously kind of buy dips per se. How does it look right now? Technically, I've been watching this bearish divergence that's held, which kind of makes me worried a little bit about the overall trajectory of BTC. But, price is king, and at the end of the day, we put in an all-time high just in October, right? So, the chart's not terrible by any means.
Yeah, on the tactical basis, we look at funding rates, how much does it cost to put on a leverage position? And on that, there's a huge leverage wipeout in October, and things look pretty washed out from our perspective. So that would be, one notch in the bullish camp. We also look at the unrealized profits on the blockchain, since you can track when every Bitcoin was last bought and sold. And that also looks pretty bullish. But against that, you have this interconnection with the AI trade and the slightly, I'd say, higher cost of funding for unprofitable tech. And frankly, the Bitcoin miners are squarely in that position, and they are, to a certain extent, the marginal seller of Bitcoin at these levels to fund those AI pivots. And then you also have the 4-year cycle, which I'd say is a bit of a headwind at this point if the typical calendar holds. So that leaves us, pretty mixed, frankly, and kind of willing to play the volatility a bit, but not married to long or short directionally.
Got it. There it is, NODE, the node, VanEck, on-chain economy ETF, guys, up to about 48 mil. Performance has been very good since inception at a very affordable, pretty cheap 69 bips by the standards of some of the thematic stuff out there. Fun conversation. Love the Bitcoin conversation as well with some of the technical analysis. Love the very rational thoughts on risk in the space and hedging in the space through various ways. Hedging via quantum, not going too wild with the DAT stuff, but also being aware that some of those NAV premiums have now been closed and might be some deal action. So maybe that short master trade not quite as sure of a thing. Great conversation, Matt. Thanks for being here.
Thanks, Oliver.
Fun stuff. Matt Sigel, Head of Digital Assets Research.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction. With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Welcome back to Chicago Future of Finance. I'm Oliver Renick. I'm here with Mr. Scott Bauer from Prosper Trading Academy. As one thing we haven't hit today, Scott, is oil, which is
plunging timber.
Just getting hammered, man.
It is.
Down to $55.
Lowest close since 2021, I think.
What's up with that? What's going on?
I think it's all supply. It's maybe a little bit because we saw those reports coming out of China of things slowing once again, right? But I think it's more just it's supply and demand. Right now, the supply is there. So we're seeing, coming into a season here where typically there's not a big demand here in the U.S. in the winter season. But the charts have been reading this for a long time. You and I have talked about this for the longest time, where the oil charts have been opposite of gold, where gold's been a buy the dip, right, for 9 months, a year. Any kind of dip you got. Oil, on the other hand, has been a sell the rip.
Sell the rip.
We've talked about that for at least 6 months now, and now we're really seeing it. Where is the bottom here? Maybe we're getting close. I think if we go back, to those levels that we saw 4 years ago, we're kind of right there.
I'm looking at it right now.
Yeah,
$55. That's a major technical breakdown.
Major.
As that held in October, May, April, through all kinds of Middle East turmoil. Pulling it back to show the 3-year chart. Before that, it was basically $70.
Yep.
That was a level. I mean,
lower lows, lower highs, and just the ultimate sell the rip. So,
I got to be honest. I don't have a lot of. I'm going to start to sound like the guy who always thinks he's right. Which, by the way, I do always think I'm right. No, but I talked to my brother about this years ago, and the reason why I actually don't cover a ton of oil, like today, for example, I hadn't even thought about it until you just mentioned it to me. But that being said, is I've just kind of been of the view that it's generally going to drift downwards. And I don't have a strong view about it other than that because we're moving away from it. It's not that complicated. I know still tons of the world uses oil. It's a very important input. But generally speaking, on the long term, we're moving away from it. So I would think it drifts downward.
We are. And what really stands out to me is if you look at those last couple years, where did we see the spikes? The spikes weren't because of anything fundamental or anything like that. The spikes were because of some instantaneous or very small blips on the radar screen, geopolitical events, and then boom, right away back to selling. And this is really a nasty looking graph if you want to be, if you're an oil bull.
Yeah.
Boy, it is methodical. It's slow. It's methodical. It's lower low after lower low, lower high after lower high.
That's an important part too. Is the lower highs. I'm going to stretch
Big
this
time.
line here because, to your point.
Yeah. So that puts us right at what? Mid-60s as the next potential, resistance area if it even gets there.
A geopolitical VIX to some extent maybe is its function here, but other than that, it's just really hard to see this as a real kind of macro indicator at this point because I think the secular trend for it is just negative.
I totally agree with that. Now, at some point, this is going to flip. Does that mean it's going to flip at 52, 53? Is it going to have a 4 handle on it? I don't know, but I would say until this pattern changes, just like with gold that we have talked about, it is absolutely a sell the rip.
Yeah. The best way to sell that rip, because here's the thing, it's a little bit tricky. If you try and go to stocks, right, very different story. Today they're getting hit. If you get the daily move right, then okay, maybe XLE as a proxy, but obviously long term, this looks like a very different chart.
So we have been short VLO, finally paying off over the last several days. Yep. Finally paying off over the last several days. And when I say short, we were short not outright the stock, but just through put spreads.
Okay.
And to me, that is the best way to play, in the commodity space. Whether you're looking at crude futures and trading options on them, or if you're just looking at a refiner or someone in the oil space like this, a Marathon, someone with big liquidity here, those markets are tight. They're liquid, they're deep, and I found a couple of the refiners to be a good proxy.
I think you got crack, right?
Yep.
As the
That's right.
That's a fun one. You got crack for your broad refiners to see today down 2.9%. So I guess these are nice because you're familiar kind of with the options, process of trading.
For
If you
sure.
like trading options, this is a way to do it. Whereas you start trading options on futures, you might be starting to dabble in something you're not totally used to.
No question
Or just
about
trading
it.
the futures outright is a whole different beast.
I like keeping it on the equity side, quite frankly. So whether I'm trading it in an ETF or just a stock, that's where my sweet spot is. And some of the refiners, they don't have as drastic of that drawdown or of that sell-off as we've seen just in spot or in crude itself. But I think it's a real good proxy.
Tell me about how maybe we look at, if I'm thinking about commodities as a macro indicator, I go to copper, I don't see anything too scary. My point is that I just don't really see the crude oil sell-off as a big, scary macro message. Jobs weren't terrible today.
No, I don't think it is at all. And in times past, that is. It's like, okay, why are we down here? Recession's coming. People aren't spending. We haven't seen that yet. Now, listen, let's wait a few more weeks, maybe another month or so until a lot of the data catches up. Later this week we've got inflation data, but I agree with you. I don't think at this point it really points to anything that says, oh man, we're in trouble here.
For inflation on Friday, let's maybe talk about that. Pete and I talked a little bit about the 10-year, that 4.2, but you and I talked about this last week.
We did.
A pretty clear, line in the sand that's held up pretty well there at 4.2%. We just bounced right off it again. Don't you love when lines hold?
Well, lines are meant to be broken. They hold until they don't.
Right.
But that's part of the nuance of trading technical analysis like this, right? And is understanding, and then also understanding when something like this breaks, that okay, the narrative may have changed, and you or me or anyone else is not always going to be 100% right, and you have to be able to go with that. You have to be able to go with the narrative and not be pig-headed enough to say, oh no, this line, there's a line in the sand, it's going to hold.
TLT offers us a slightly different take when you go 20 plus years, because this one does look like it's a little bit more of an actual downtrend, kind of since October, whereas the 10-year looks like that battle's really happening at 4.2. I could look at the lower lows on TLT and say, my conclusion from that would be expect some higher highs on 10Y on the yield. What do you think
Absolute
about
longer
that?
end of the curve, right? So that's why you're seeing that there, the 10 versus TLT, which is 20-year, and that's where the real stickiness has been the further term you go out.
Yeah. Short TLT by puts. What do you think? Is there a trade in bonds?
TLT is a tough trade for me.
It's been tough.
It really is. If we start to see rates come down, a lot of that may happen after we get data on Friday, the inflation data. If we start to see bonds rallying, rates come down a little bit, okay, then maybe I'm in the camp of, okay, this is sustainable. But so far it hasn't been, and it's really, you play the range, right? Just like you look at those technicals and say, oh boy, 420 in the 10-year has been that line in the sand. Boy, what a range we have seen, though, whether it's in the 10-year or in TLT. And if you have played that range, boy, you've done really well. At some point, it's going to break out of that.
Pretty wide from 3.9 to 4.2.
Oh, yeah, for sure.
It's kind of fun the way it's almost symmetrical.
It really is. Look at that.
When it was above 4.2, like this whole section here, right? It's like a mirror image.
So if you were to, put that guesstimate out there and we get another mirror image and it replicates again, would you say that's then 3.6 to 3.9, or would it be on the upper end, back maybe 4.2 to 4.5 or so?
That's who loves to do that. Nuckman, I think, that talks about kind of, and I think it's just a general technical kind of theme where you look at the width of ranges, and then if you break then a key level,
sure,
you kind of shift it, you translate it down. So then, to your point, if this were to break higher in yield, then I would kind of say, all right, back to 4.2, 4.5. But if it breaks down and we start threatening the lower end of this 4, by the way, I don't know, this chart obviously has been downtrending in yield. Stocks have been okay during that period. Stocks have been pretty great during that period overall. So it's a risky game to try and play stocks off of yields. But my gut kind of tells me right now that you probably don't want a bond market moving too far above 4.2 or too far below 4.
Complacency is the best thing for the market
Yeah,
right
right.
now.
Just
There's no
relax.
question about it. If we continue to trade in a 4 to 4.25, 4 to 4.2 range here, equities are going to do just fine.
Yeah. There's the bell right there. Scan the QR code to join the team to prosper. Maybe we'll catch up with Charlie this week for some momentum tech stuff.
Absolutely.
And that's it for us today. Mr. Scott Bauer joining me here from Cboe for a great closing hit. Appreciate it, Scott. Fun time in Vegas. We're back home now. We had a little viral TikTok out there.
It was pretty good.
And we had a lot of good food.
Oh, yeah.
Yeah. All right. Appreciate it. That's it for Chicago Future of Finance. I will see you tomorrow, 2 p.m., same time, right here from the Cboe. Have a great night.